Good afternoon, everybody, and welcome to the latest tax update from Brown Butler. The usual format for this, so we'll be talking for the next hour maximum. Today it's just myself and Vicky who are presenting. I'm a tax director here at Brown Butler and head of tax. Vicky is our director of private client services. As always, we will be recording the webinar, so if you want to watch it again, please look out for the link that's going to be sent around shortly after we finish today. In terms of the topics for today, I will be just going through a general roundup of topical tax issues and things that we've come across recently. Vicky will be focusing more on the private clients and in particular two areas. One is looking at the forthcoming budget, which has been announced for the 26th of November. And secondly, looking at the changes to inheritance tax, which were announced last October. I know we've gone through that previously, but there have been some updates from the revenue in recent weeks. And also, it's an important topic and certainly one that we're finding we're having queries about on a regular basis. So make no apologies for going over that again. So looking at just a general roundup of some topical tax issues over the last 2 or 3 months. Uh, Firstly, just quickly on the reintroduction of the winter fuel payment and the mechanism for how this is going to be dealt with from a tax perspective. So from winter 25, from this winter, winter fuel payments have been restored and the payment is between 100 and 300 pounds. However, if an individual's annual income is over 35,000 pounds, payment of that amount is going to be recovered through the tax system. Now, this is a sort of a cliff edge threshold in that anybody with an income of £1 over £35,000 will have the whole of the winter fuel payment clawed back. In terms of what is defined as income for these purposes, we're looking at total income. So it's before any deductions for things such as gift aid. Now, in terms of how this is going to work in practice, for individuals who are in self-assessment, the payment will be entered in their return. For others, there'll be an adjustment to their PAYE code in 2627. Now, the plan is that from April 27, the payment will be recovered in the same year in which it is made. Now, individuals can opt out of receiving the winter fuel payment, which will avoid the need to go through the process of having it clawed back, reporting on tax return, or getting it adjusted through their PAYE code. However, in order to do this for this year, they need to opt out by the 15th of September. So it's next week, next Monday. Changing tack completely here, looking at some property and pensions. Now it's encroaching a little bit onto Vicky's territory here because I'm going to be it's mainly focusing around the changes to IHT. And historically, many entrepreneurs and business owners have quite rightly transferred their trading premises, commercial property, into SIPs or SASs. I mean, this was always been very efficient, very tax efficient planning. Those assets can grow in a tax-free environment. And in terms of profit extraction, it's a very tax efficient way of getting profits out of a company, for example. So all's well and good until we get to April 2027, when, of course, pension funds become subject to inheritance tax. And pension funds themselves do not qualify for either business property relief or agricultural property relief. And so we have a problem. Therefore, what's the solution here? Or what's a possible solution? Well, one is to look at buying those properties back from the pension scheme. Now, this isn't something that needs to be looked into lightly. It requires some very careful thought. But one of the advantages of doing so is if that property then is in the individual's own name and it's used in a trading company under their control, this brings business property relief and agricultural property relief back into play, albeit at a rate of 50% rather than the 100%. But remember, the 100% rate is capped at £1 million anyway from next April. There would also be the possibility then of, once it's in personal ownership, of gifting those assets away as a potentially exempt transfer. And also, in certain circumstances, it's possible to claim capital gains tax holdover relief if they've increased in value since they were acquired from their pension fund. Now, one of the big points around looking at extracting properties back out of pension schemes is the fact that everything needs to be done at a market value. So that is important, and that can have a knock-on effect for SDLT, of course, in that SDLT will be payable based upon the consideration paid for the asset coming out. And that could be quite a significant cost in terms of weighing up the cost benefit of going down this particular route. And if the property is going to be retained when extracted from the pension fund, then of course any rental income received would be subject to income tax in the hands of the recipient. So again, a few things there which need to be considered before going down this particular route, but it's something perhaps to have on the radar when thinking about the wider implications of the IHT changes which are coming in. And I want to bring to your attention something that was in the HMRC agent update in June this year. So what HMRC are doing at the moment, they are writing to customers in their terminology, who between April 19 and April 23 have received a director's loan which has been written off or released, and in HMRC's words, may have not declared that amount as income in their self-assessment tax return. Now, when a director's loan account, and here we're talking about overdrawn director's loan accounts, when an overdrawn director's loan account is written off, that amount is liable to income tax under Section 415 of ITOIA in the director's hands. And there could also be other tax issues around this as well, looking at it from in terms of benefit in kind on the notional interest charge, corporation tax, if there's any Section 455 exposure there, and national insurance contributions, because whilst a waiver or write-off of a director's loan is usually subject to dividend tax or the rates associated with dividend tax, they can also be subject to national insurance. So something to be mindful of there in terms of HMRC's current campaign on directors' loan accounts. Now, what we're talking about, directors' loan accounts, something that we've been looking at recently and also over the years is around gifting or assigning a director's loan account within, say, a family in a typical scenario. And this can all be around general IHT planning as well, because a director's loan account and what we're looking at here is money is owed to the director from the company rather than an overdrawn director's loan account. That loan would be an asset for an individual, and it's included in their estate. Doesn't qualify for business property relief or agricultural property relief. It's a simple loan. So in certain circumstances, there may be consideration given to assigning that loan to adult children. Now, notwithstanding any tax implications of doing this, it is important that legal advice is taken to make sure that everything is done properly from a legal perspective. For example, taking into account the director's fiduciary duties, enforcement of the debts, and it being actually legally assigned. So it's all properly done and has legal effect. Now, assigning the loan, it would be a gift and therefore would be a potentially exempt transfer. And so the usual rules apply that if you survive 7 years or more from the date of the gift, and there's no reservation of benefit, then the value of that loan should fall out of the estate of the donor. Now, it's important here that the possession and enjoyment of that loan is assumed by the recipient. Otherwise, you could have issues around the gift of reservation provisions. And in the inheritance tax manuals, there is some guidance there, and it does mention that mere legal right to enjoyment is not sufficient. So if the funds from the loan are, say, tied into the company in some form or another and cannot be extracted or enjoyed by the children, then that concept of possession and enjoyment is probably not going to be satisfied. So some of the things that you need to consider when you're looking at this sort of planning is that we would advise that the loan is interest bearing, and then the recipient will enjoy the income from the loan. So it's a genuine economic transfer that they're getting. Charging a commercial rate of interest could then be akin to if the company had sourced external funds. So again, it just helps to make that case as robust as possible. The loan generally should be repayable on demand, ideally. So, the risk of a successful gift reservation challenge will be mitigated if it's repayable on demand, the terms are commercial, and indeed, if it can be shown that regular capital repayments are made by the company to the children. And of course, it's not always possible commercially to do that, but this is sort of best practice really in terms of mitigating the risk as far as possible. If there is thought given to assigning loans to minors, for example, grandchildren, then we need to consider the bare trust rules, and it's likely that such a trust would be required to be registered on the trust registration service, as this will be held on behalf of a minor and is not cash. So moving away from the topic of directors' loans, just highlight a spotlight which was published back in April, Spotlight 69. Now, just as a reminder, spotlights are a mechanism for HMRC to bring to attention tax schemes that they've been made aware of, and they set out why they don't think those schemes work, and in essence say, taxpayers shouldn't be engaging in such planning, and if they do, then it's likely there'll be an inquiry and possible not only the tax to repay, but interest penalties and such like. So this latest spotlight, this is all around liquidation of an LLP used to avoid capital gains tax, and it's part and parcel of various planning ideas, which we've spoken about in recent seminars, webinars, around trying to avail ourselves of incorporation relief when transferring property portfolios into companies. And there have been various high-profile cases along those lines where sort of manufactured structures have been put in place to try and get a best of both worlds scenario. So in this case, the planning, this tax avoidance scheme is being marketed to landlords, which purportedly enables them to transfer their property business to a company using an LLP as a conduit in order to save capital gains tax. In HMRC's view, the scheme doesn't work, and ultimately the taxpayer may have to pay more than just the tax they've incurred, like I say, because they'll be paying interest and penalties as well. Just in sort of overview, so you get a feel for what the structure looks like in case you come across it. It's typically structured along the following lines. So we've got an existing property business that's just operated as an unincorporated business for a number of years. The individual then incorporates an LLP, so we need another member to actually do that, and the properties are transferred to the LLP, and often these have got some substantial inherent capital gains within them, and they're transferred in at market value. So the transfer to the LLP at that point in time doesn't trigger any capital gains tax charge because of the transparency of the LLP, the individual hasn't made a disposal, at least not from a tax perspective. So after a short period, the LLP is then put into members' voluntary liquidation. And as part of that liquidation process, the properties are sold to a limited company, which is owned by that landlord and all connected parties. Now, where this planning tries to get clever as such is that when a LLP goes into a members' voluntary liquidation, it's deemed to acquire the assets at the time of those contribution of those assets to the LP for their market value. And therefore, the idea being then that when they get distributed on the liquidation into the limited company takes them on at their market value. Now, like I say, HMRC are convinced this scheme doesn't work. It does seem to be very convoluted in terms of getting to that end result, and so you'd certainly view any such arrangement with extreme caution if you came across it. Just moving on now to sort of a different topic to what we've typically spoken about on these sessions. Looking here at due diligence, and this is just to highlight some areas that again we've seen ourselves in the last few months in terms of areas that can have some risk if you're on either side of the transaction, but typically impacting the vendors more so than anything. And the first one is around what we call upstream loans and the exposure to Section 455 tax, as in overdrawn loan accounts. So in a sort of classic sort of MBO structure, a new co is formed to acquire a target company. Consideration is lent from target company to NewCo and then paid out to the exiting shareholders. So we have an intercompany loan between NewCo and Target Co. Now, technically, that intercompany loan is subject to Section 455 tax if it isn't cleared within 9 months of the year end in which the debt arose. And whilst intercompany loans, you wouldn't normally think about Section 455 being a particular issue, the reason why it potentially gets caught here is that there are provisions in Section 459 for indirect loans. And the analysis is that because the money's lent ultimately end up in a participator's hands, because it's there funding the consideration for the sale proceeds, that then brings that loan into the ambit of Section 455. And so typically you want to clear this by way of a dividend. That would be the normal way of clearing that loan. But of course, that has an impact on the balance sheet of the target company because that has to be paid out of reserves. And sometimes these sums can be quite significant. And indeed, the target company may not even have the reserves in order to fully clear that loan with a dividend. Now, in practice and kind of anecdotally, HMRC rarely seem to take this point, but it's often picked up on due diligence, in which case very often the position has to be rectified, perhaps even a voluntary disclosure made to HMRC to put the position back on a regularized footing. Now, the Institute has been corresponding with HMRC on this point, just to try and remedy the position, because there's no tax avoidance motive in these types of structure. It's just a way of funding a management buyout, and therefore, there's nobody's trying to be clever here or create any mischief. However, at this point in time, HMRC appear to be unmoved about that. Now, employment-related securities is always a big topic potentially in a due diligence scenario, only because the rules are very complicated and can pick up all sorts of transactions that you wouldn't necessarily come across. Some of the more common areas which come out on due diligence are Section 431 elections, or more correctly, the absence of these. So Section 431 elections, you would use these whenever an employee or a director acquires shares in a company. Just as a reminder, by making the election effectively, what you're doing is you're making sure that any growth in value of those shares from the time of acquisition to the time of sale is all subject to capital gains tax. In the absence of a Section 431 election, part of that growth in value could be subject to income tax. And because the income tax is normally triggered on a disposal scenario, it then falls within the ambit of PAYE. So you have NI, both employees and employers. And again, some of the amounts that are involved in these type of scenarios can lead to some quite significant adjustments to the purchase price, potentially. So Section 431 elections is a key thing to be mindful of. Now, there is an exemption for where you have transfer of shares between family members. The terminology in the legislation is that where there are domestic, family, or personal relationships between the individuals, then typically there is they fall outside of employment-related securities, and so a 431 election isn't required in those circumstances. But again, that's something that just needs to be looked at and reviewed because it doesn't potentially apply to every single set of circumstances you may come across. The other aspect of employment-related securities is around the ERS returns. So typically you'll have, if you have an EMI scheme in place, there's an EMI 40 to file every year. For any other share transactions, you have the ERS other form, what we used to call the Form 42. So those need to be filed by the 6th of July after the end of a tax year, reporting any transactions that have been undertaken during the year. But also nil returns are required where there has been no activity. And this can sometimes trip people up. And if those returns haven't been filed, there are then late filing penalties. And if that's been done for a number of years, those penalties could rack up. One point to note here is that leaving aside EMI for now for the sort of other, the Form 42 type returns, that you can actually close a scheme. It's not really a scheme, but that's the terminology used. You can close it so that no further returns are required in future periods. So that's one way of at least taking away the compliance sort of obligation from doing that. On EMI schemes, just something to be mindful of here is that typically the way an EMI scheme works is you'll get the valuation agreed with HMRC. That's valid for 90 days. So long as the grant of the option is within that 90-day period, you can rely upon the valuation as agreed with HMRC, but only if there have been no material changes in any circumstances in the meantime. And indeed, HMRC now put this on their letter when they come back confirming the agreement to the valuation. So if there have been any transactions in the shares, or for example, any discussions with a potential purchaser in that period from the date the valuation was agreed to the date of grant of the option, then best practice is to go back and reconfirm that valuation with HMRC. Otherwise, there could be some question marks around the validity of that valuation. Moving on from due diligence, I thought it'd be worth just adding a couple of slides on employee ownership trusts. We're certainly having a lot more conversations around these structures in recent months. I think particularly with the capital gains tax rate increasing and business asset disposal relief being withdrawn, or at least the benefit of it being reduced over the next couple of years, becoming more popular. There were some announcements in the October 24 budget, which I'll come on to shortly, just bolstering the requirements around EOTs. But in essence, what they're there to do is try and promote this kind of John Lewis model of employee ownership and employee engagement. The big headline, of course, is that from the vendor's point of view, where the EOT acquires more than half of the trading company or group, there is no capital gains tax on the vendor for the sale of their shares. But of course, in order to have that benefit, there are various hoops and conditions which need to be met in order to avail yourselves of that tax-free disposal. Certainly, the EOT has to be for the benefit of all employees, all employees. That's a very major condition. It's important that no more than market value is paid for the shares. So from the trustee's perspective, there would be a potential breach of trust, and so a professional valuation is recommended. The excess amount could be taxed on the vendor as employment income, and there could be various other ramifications as well for such a transaction. So that is absolutely critical, that market value is paid for the shares. The way these transactions are often structured is that the consideration is on deferred terms, and that consideration in essence is funded out of the trading company's profits by them making contributions to fund the payments of consideration to the exiting shareholder. Now, qualifying EOT, every year you can make a tax-free bonus, but not NI-free, a tax-free bonus of up to £3,600 to employees. And again, this all-employee concept is important here in that, bar some exceptions, all employees have to benefit in some form or another of that bonus. You can differentiate in terms of length of service and such like. However, everybody needs to get something. Now, I mentioned the changes in October 24. these were introduced just to tighten the compliance and the tax reliefs around EOTs. So firstly, the period in which the capital gains tax can be recovered from the original vendor, if any of the conditions are breached by the EOT, that's now extended to the end of the 4th tax year following the initial sale, whereas previously it only ran to the end of the 2nd tax year. All EOTs have to be UK resident from now on, and the former owners cannot control the EOT. This was always a bit of an issue for the revenue, whereby the vendors would form the majority of the trustees at the EOT. So in essence, nothing fundamentally changed as far as the ownership of the company was concerned. But now there has to be other trustees which form the majority of the trustee board for the EOT. There are some provisions just giving more certainty around the contributions from the trading company to the EOT to satisfy the consideration. Just to confirm that they wouldn't be taxable within the EOT. And finally, more disclosure now is required in the tax returns of vendors. So a lot more details around the nature of the transaction, who it was sold to, the valuation basis, and that kind of thing. Finally, I'll just end on making tax digital. I think every seminar now has to have some kind of MTD content to it, but the D-Day is looming. So as a reminder, landlords, it applies to landlords and self-employed from April next year, where turnover is above £50,000, either or combined together. And in essence, MTD compatible software will be required to make quarterly returns to HMRC, plus the self-assessment tax return at the end of the year. Now, £50,000 threshold is reduced to 30,000 in April 27 and 20,000 in April 28. Now, initial estimates are that from April 26, about 860,000 taxpayers will be within this regime. And by the time we get to 2028, that could be up to about 2 million. So quite a significant base of taxpayers there being brought into the MTD regime. And we've now had kind of confirmation on the quarterly reporting deadlines. They're in line with what we thought they would be. You can see there, I won't go through them in detail, but you can see the first quarterly update for the 26-27 year will be the 7th of August 2026, and then quarterly thereafter. I just highlighted a couple of periods there in red where there could be some potential pinch points from a practice point of view. And this is around sort of January and February time each year, whereby on the 31st of January, that's the usual self-assessment deadline, of course. And then the 7th of February, there'll be the 3rd quarterly update due. So that could be quite a busy time in terms of information gathering and such like. So that's all I wanted to have a chat about. I will now hand you over to Vicky to talk through private client matters. Thank you.
Thank you, Craig, and welcome everybody. The first section here is sort of talking about the budget that's been announced for 11 weeks' time, 11 weeks tomorrow, on Wednesday, the 26th of November. There's been lots of speculation about what she may include in this budget, and I'm sure there's going to be more speculation in the coming weeks. And obviously we don't have a crystal ball. It would be great if we did know what she was going to do, but these are just some thoughts. And as ever with tax planning, it's important not to rush into doing anything, to think about the non-tax factors as well if you're thinking of doing anything, and to really think it through. So these are not necessarily going to happen, but they're just some ideas, many of which you may have read or seen speculated. So will she further freeze the income tax thresholds for longer than she's already said. She's pledged not to raise income tax, national insurance or VAT. So freezing tax thresholds wouldn't be her going against those pledges. But obviously there's the possibility that she could do anything. What does seem to be clear is that those with wealth look likely to be going to suffer a higher tax burden, even if she doesn't introduce a wealth tax in name. So just on the topic of a wealth tax, earlier this year, the Chancellor said we're not interested in a wealth tax, but obviously things can change as the economy has more of an effect on the size of the black hole that she's got. There really is scepticism about whether a wealth tax would be introduced. It is something that's been looked at over the years, and it's not clear how much wealth tax a wealth tax would actually generate. And in some ways, it really seems that she could essentially tax wealth by extending the existing rules instead. And given that there are only 4 countries in the OECD that currently have a wealth tax, being Colombia, Norway, Spain, and Switzerland, it's not the case that the UK is strange in not having a wealth tax. So just thinking about other things that are more likely that she could well do. She could choose to make further changes to capital gains tax and inheritance tax, even more than was announced in the last budget in October last year. Over the years, there have been various different options and thoughts as to what could be done. Some of those have come out of the Office of Tax Simplification before it was disbanded. So there's a whole host of things that she could look to introduce that may have been disregarded or not taken into account in the past. She could look to increase capital gains tax rates further. She obviously increased them in October last year. But what she does have to be careful of is that sometimes there's evidence that increasing capital gains tax rates does actually alter the behaviour of individuals, and actually it can result in less tax being generated than if the rates had just stayed the way they are. There has also been speculation that capital gains tax private residence relief, that's the exemption from an only or main home, could be removed or altered, especially for higher value homes. There's been talk of whether this would essentially be a mansions tax for properties that were worth over 1.5 million. So that would be a very significant change in the capital gains tax rules, but it is one that has been raised as a possibility. Something that's fairly technical, but has been, something that's commonly used, is the fact that when somebody dies, the capital gains tax inherent in their assets disappears because they get capital gains tax uplift on death. Now, if this was removed, it would be very unpopular, as it would impact many families. But this is something that was raised by the Office of Tax Simplification. So in terms of how that could work in practice, if assets weren't automatically uplifted to market value on death, such that you only paid inheritance tax, it possibly would be the case that beneficiaries would inherit the deceased's original acquisition cost. So if they were then to sell that asset on, they'd obviously have capital gains tax to pay at that point. Or possibly it could be the case that beneficiaries would be given the option as to whether they paid the capital gains tax on death. And so essentially, would they then get to deduct that capital gains tax charge from any inheritance tax that they had to pay? Now, the nil rate band is something that hasn't been increased for a number of years. The nil rate band has been £325,000 since 2009, so it hasn't kept up with inflation. So if she was to remove the nil rate band, that would be something that I don't think would happen, but that would be very controversial. There is also the concept of the residence nil rate band that can apply to certain individuals with assets below 2 million, where the value of a home goes to direct descendants. That can provide an extra 175,000 allowance, and we've talked about it several times on these webinars before. Now, that is something that has proved very complicated to work through in practice, the residence nil rate band. So whether that could be something that would be more likely to remove is something that we'd have to see. But again, enabling a married couple in the right circumstances to be able to pass on £1 million worth of assets without an inheritance tax charge is something that would affect a number of people and would be very controversial. Could she look at changing dividend taxation? There's been talk of introducing a new property tax that would essentially replace council tax and stamp duty land tax? Could she be thinking of introducing a national insurance charge on rental income? Now, landlords have suffered numerous tax changes over the years that have made the receipt of rental income less good from a tax perspective. And there are various different things and interesting points that raises in terms of rental income can't count towards the amount that you're allowed to put into a pension. But if it did start to have national insurance payable on it, might that see that rental income could count as part of your calculation and what you can put into a pension? There's also been sort of talk as to, because of the comments that she's made on ISAs, whether the cash ISA limit of £20,000 per tax year might be reduced to try and incentivise people to put their funds in more stocks and shares. Again, that's something that we'll have to wait until the end of November to see. And in the run-up to last October's budget, there was quite a lot of talk about whether the tax-free cash amount, the 25% that you can take from pensions, might be reduced. And again, that's something that potentially could be altered. So that's just sort of raising a few things that you might have seen, but now moving into some of the changes that she did bring in October last year. We've now had draft legislation that was issued in July, and we've also had a summary of the responses that were made to the consultation that was raised after that budget. Now, these pension changes come in 6th of April 2027, so there is still a bit of time before these changes come in, but they do impact most unused pension funds and death benefits from that date going forwards. What they have said in that is, which is good clarification, is that death in service payments paid by employers will remain outside the scope of inheritance tax for now. So that was a welcome confirmation that came through. What they have confirmed is that the 6-month payment deadline that's normally associated with when somebody dies will still be the same deadline, regardless of the complexity that bringing pensions within the inheritance tax charges brings. So these changes will definitely increase the complexity, the delays and the stress of dealing with somebody's estate when they die. And the revenue will need to develop new systems to help handle this charge. The legislation and the responses do confirm some changes here, because originally they'd set out that it would be the pension scheme administrators who'd be liable for reporting it. And due to some of the comments that were made, that's been changed about the practicalities of how that would work. So now it's been confirmed that it will actually be the personal representatives that will be liable for reporting and paying any inheritance tax due. Now, personal representatives would be the ones that usually deal with these probate forms anyway, but one of the key differences here is that usually the personal representatives would have more of a say and be able to dictate more about having access to the funds to pay that inheritance tax, and they aren't going to have any that power over the pension funds themselves, which we'll come on to think about some more in the coming slides. What it has been said is that the legislation as it comes in will make it clear that pension beneficiaries will become jointly and severally liable for the inheritance tax due on those pension funds on the amount that they're entitled to of those pension funds from the point they're appointed. So there is some help there, but as I come on to say, it still does make it seem more risky and more complicated for personal representatives going forward. As we've touched on in the previous webinars, unfortunately, the fact that pensions are being brought into the inheritance tax net isn't the only tax they're going to suffer, and the rates of tax can get quite significant. Because as well as being subject to inheritance tax from April 2027, they may also still be subject to income tax in the same way as they are now if the deceased has died over the age of 75. And that, as I say, depends on the deceased age at death and the type of benefit that's being taken. Where a pension pot suffers an inheritance tax charge, what the legislation and discussion does make clear is that the pension pot will be able to suffer the inheritance tax on that pension pot, and there should be no income tax on that element as well. So if the inheritance tax has been paid from other funds, i.e. it's been decided that the pension fund won't actually fund the inheritance tax charge itself, there will be a method to seek to gain a refund of at least that element of the income tax when the pension's taken. But what is clear is that you can't try and have a pension fund suffer more than the tax that should be borne by it. It can't be used to pay for the IHT on non-pension assets and try and get the fact that you don't have an income tax charge on it. They've thought about that, and that's not going to be possible. They have confirmed that the existing inheritance tax principles will continue. So if the death benefits from that pension pass to a surviving spouse or civil partner or goes to registered charities, then there would be no inheritance tax at that point. As Craig mentioned in his earlier slides, what has also been confirmed is that you can't obtain agricultural property relief or business property relief on the assets that are within the pension fund. So that's why some thought should potentially be given to whether action should be taken if a pension fund does contain those assets, because it's essentially being wasted. And if the personal £1 million allowance isn't being used, then that could be a way of reducing the overall tax liability of the individual concerned. But what you do have to consider is that the individual would likely have to own the assets personally for the qualifying period, and it wouldn't necessarily include the ownership in the pension fund as well. And again, that's something which presumably will be clarified over time. The draft legislation does close for comment on the 15th of September, and there will be further guidance issued before these changes come in on the 6th of April 2027. Now, we've touched on the fact that the pension funds will suffer inheritance tax, and obviously the practicalities of if that's going to be paid by the pension fund, how quickly that can be done, does depend on the assets that the pension fund contains and how liquid they are. So other things that have been clarified is that the pension schemes will need to provide information to non-exempt beneficiaries when they're making it clear what the benefits of that pension fund is, so that there's clarification and it's clear to people how these rules are going to affect them. When somebody dies, the timeline that's expected is that personal representatives will be given information within 4 weeks of the pension funds having received the notice of death. In terms of how the inheritance tax will be paid, it could be paid directly from the free estate, and then that's where I've said there'll be some ability to claim a repayment so that income tax isn't overpaid overall if the pension fund is taken as an income after that. It'll be possible for the beneficiaries, so the pension beneficiary, to direct the pension fund to suffer that tax. And if you take the pension in full and suffer an income tax charge and then pay the inheritance tax directly, there'll be the ability to get a refund of the extra income tax that's being paid compared to if it had been paid from the pension fund first. And what they have also clarified is that death in service benefits paid to non-discretionary pension schemes, which are currently in the scope of inheritance tax, which can apply to NHS and other public sector schemes, will actually be out of the scope of inheritance tax from the 6th of April 2027. So that's a benefit for those people that would usually suffer a charge, but that won't necessarily affect that many people. There have been some comments already submitted and shared by the professional bodies, one this week that was shared by the Association of Tax Technicians. They're worried that the changes here do increase the risks on personal representatives and may impact the people that are prepared to be appointed as personal representatives. They'll, as I said, be liable for inheritance tax on the assets that aren't actually under their control. There will be complexities that could be expected where you've got different beneficiaries. So the beneficiaries of the free personal estate and the beneficiaries of the pension fund aren't the same. Will the beneficiaries of the pension fund cooperate if there's inheritance tax to pay? And if you've got overseas beneficiaries, it's much harder to get any redress to them if they don't choose to pay the taxes. So then that was thinking about the inheritance tax changes, but one of the things that people are now thinking of is that because pensions are coming into the inheritance tax net again from April 2027, should they be drawing down those funds so that there's less value in them when they die? Now, it's key to involve independent financial advisors in these decisions, because obviously a lot of it depends on investment advice, and it does depend on what type of pension you have and how flexible it is. Now, not all pensions necessarily have the flexibility to provide the type of income drawdown that you'd want, and potentially many workplace pensions are in that position, but it should be possible to transfer to an alternative plan to remedy this position, but you'd obviously need to take advice and see what the circumstances are. Taking income from pensions can be confusing. What you're considering doing needs to bear in mind that the rules aren't coming in until April 2027. It does also need to take into account the tax-free lump sum that can be taken and what effect that has on the level of income that you can take, and whether you can actually keep putting money into the pension fund as well for a bit longer. In most cases, it's possible to take up to a maximum of 25% of the pension as a tax-free lump sum, subject to an overall limit of 268,275 if people have managed to get a higher protection level over the years. And there are different ways that you can use to access the remaining pot to provide an income if you do choose to take that lump sum all in once, or you could choose to take that tax-free amount over a number of years as well, and essentially that could provide a tax-free income. There's for income drawdown, there's the flexible income directly from the pension, and you can leave the rest of the pot invested. You can control the frequency and amount that you take, and you could also consider whether an annuity is right for you. Cap drawdown is something that's no longer possible to open a new one now. That has a limit on the maximum amount that can be taken as income in a year, but then it's still possible to retain the full amount of annual allowance for continuing contributions. If you have a flexi access drawdown, there's no maximum limit to the income that can be taken, and any new income drawdown arrangements since April 2015 would automatically fall into this category. And one of the downsides of this is it reduces the amount that can be contributed into the pension going forwards. And that cap is a maximum of the £10,000, which is the money purchase annual allowance, and can be affected by what your taxable income levels are. Now, what has to be remembered is that with these things, unless it's an annuity, there's not a guaranteed income for life. And so it would need sort of hands-on investment advice and to consider various different factors. Now, as well as the pension changes, significant changes have been made to business property relief and agricultural property relief. We went into those in a lot of detail in the previous webinars. Again, draft legislation has been issued and consultation outcomes. They've only made some minor changes to those, and in the coming slides, I'm just picking up on some of those and going into some detail on the trust as well, which you might want to sort of read more on those as well, as I'll only be able to go quite high level on these. Significant changes are required to people's long-term strategies due to these changes, where they'd formerly thought that their business property relief or agricultural property relief would shelter them from inheritance tax. Given that the £1 million allowance is coming in from April next year. It's important to estimate the impact that the changes will have and the tax that's potentially at stake on an estate on death, to think through how that would be met and what action might like to be taken during lifetime. And sometimes, sadly, it's going to be necessary to establish a strategy for the survival of the business or the farm, because these are very significant changes to the tax landscape for those affected. In terms of whether you want to make lifetime gifts, to think around this and hope to survive it by 7 years, there is a capital gains tax downside from lifetime gifting, because there's capital gains tax as well as inheritance tax to consider. But can you claim holdover relief? If it's an individual gifting them to an individual, you have to take care if there's any non-trade related assets, because under section 165 of the holdover relief, that can limit the amount of holdover relief that's allowed, and you can get unexpected tax charges that can't be held over. So just take care on those, but that same restriction doesn't apply with a gift of assets into trust, but obviously then you have to think about the limits and how those work with the rules that are coming in and the forestalling rules. Make sure that you're thinking about accepted assets. because if you haven't taken those into account and they're not covered by agricultural property relief or business property relief, that could result in an entry charge if you're giving those into trust, and that amount falls to be more than the available nil rate band. If insurance is something that's going to become increasingly popular, it may be that there's insurance in place already, but that was based on more business property relief and agricultural property relief being available. So is it sufficient? Is it properly structured so it's tax efficient? The payment of the premiums, are those covered by regular gifts out of income? And is any reporting required to HMRC to claim that? There has been an important clarification that the £1 million allowance is not transferable between spouses and civil partners. So really the thought does need to be given from a tax perspective as to how you can make sure you don't waste that. Because if you left all assets to a surviving spouse without using it, you wouldn't get the benefit of that band. Now I'm conscious that I'm talking through these quite quickly, just seeing the time that's ticking there. I think in doing anything, you just need to be careful not to be too clever and really do think about it carefully and think about the tax and non-tax issues here. Practically, with lifetime transfers, it can be hard to make sure that the settlor is completely unable to benefit if they're thinking of setting up a trust. So that's why often farm trusts are only created on death because of the problems that causes. Again, trusts and partnerships don't sit comfortably together. If you have a trust as a partner, it makes it a mixed partnership, and that can lead to restrictions in the annual investment allowance. If you have more than one individual putting funds into a joint settlement, you can have more than one settlor, and then you'd have to do separate inheritance tax returns. And if you've got separate settlors, it would be thinking about what their allowance is in terms of that £1 million. And again, just a reminder to take into account the transitional rules that we went into in more detail the last time. So the legislation has been issued, it is complex, it's still being analysed. It does say that the allowance will be indexed in line with CPI, but equally they've said that it's fixed and not going to go over £1 million up to the end of April, 5th of April 2030. They have confirmed that they're not extending the related property rules. So that initially they'd said that they felt that shareholdings that were in trust settled by the same person should be amalgamated after these rules come in, which could have led to higher values for those shares. But they've confirmed that they're not planning to do that now, which is good. They have confirmed that there'll be the option to pay the tax in the 10 equal instalments, 10 annual instalments, interest free, which is good. And as I said, things are mainly proceeding as they outlined in the consultation documents. So what this confirms is that £1 million allowance refreshes for an individual on a 7-yearly basis. But as I said, there's no transfer to a surviving spouse if it's not used. And the £1 million allowance is allocated on a chronological basis as the nil rate band would be for both individuals and the trust charges. There was some talk about whether people would be able to choose how it should be based, but they've confirmed it's just going to be done on that time basis. And transfers made before the rules were announced in October won't be taken into account in determining that £1 million allowance. They have explained more about the anti-fragmenting rule. So assets added to multiple trusts after budget day, that £1 million allowance that trusts get would be allocated in chronological order, and then that would show what the maximum that the trust could have for the lifetime of the trust. And we're all assuming that if transfers are made between spouses, that doesn't use any of this £1 million allowance. I haven't seen any commentary to suggest that we should be worrying about that, but it's just raised there for completeness. There have also been detailed discussions as to how the trust charges will work. These are fairly complicated, so it might be that you just want to read through these slides. But what it does make clear is that it's something that people involved in doing these trust charges for relevant property trusts do need to get your head around these changes and keep a track of how these progress as we get more information and as these rule changes come in from the 6th of April next year. There will be some transitional relief for those trusts that were set up before October that have a 10-year anniversary after the rule changes come in, and there is some flexibility as to how trusts caught by these rules might be able to unwind themselves if they feel that that's the most sensible course of action and the timescale that could be done with. And then it does also clarify that exit charges need to be taken into account as well when you're looking at what the £1 million allowance is for these trusts. So moving on to the next slide, it's just important to bear in mind what they have also said is that the calculation of tax charges for relevant property trusts is going to change. They're going to be different now to how they currently operate. At the moment, if you've got a trust that doesn't have any tax to pay at a 10-year anniversary, for the next 10 years after that, you don't have to worry about any inheritance tax being payable if capital is transferred out of the trust. But they're saying that that is going to change. The way that you have to look at the tax rate for exits is going to be based on the unrelieved values. So it will be possible to have an exit charge on a trust, and it cannot just be assumed it's zero. It could be as high as 6%. And this means that valuations will be required more often as well. So just moving on, it does also say that the £1 million allowance split doesn't apply if the trust existed at the 29th of October, but it does say that those trusts would have to have held qualifying property. So if you're in that position, each of those trusts should be able to benefit from their own £1 million allowance. And they've also confirmed that if an individual has a trust that isn't within the relevant property rules that's taxed on their death, the £1 million allowance for that beneficiary would be apportioned between their free and that trust interest, and also failed gifts. Just a final few points. Agent update in June did have some reminders if you're involved in doing tax returns and you didn't do a tax return last year for yourself or for clients, that you need to just make sure the account's actually reactivated before you submit that tax return. Otherwise, there could be delays in having it processed. And then moving on to some just sort of very high level points. There's going to be a compulsory registration for tax advisors from April next year, where there's going to be more information on that in the coming months. Recently, in some of the pensions updates that the Revenue share, the pension newsletters, they've confirmed that they're going to be looking more at individuals that are trying to claim relief for pensions through their tax codes especially, and they've set out what information would be required to support that and how individuals or professionals could supply that information to the Revenue. And they have also confirmed that they're going to be targeting claims for personal expenditure because they feel that people are potentially claiming too much. So again, it might be worth you having a look at those if you feel that they're appropriate for you to see what you could do on those. But thank you, that was a whistle-stop tour, and I'll pass you back to Craig.
Thank you, Vicky. Yeah, that's great. That lots of stuff covered there. All of it, I think, is going to be important in some form or another to a lot of people. Thanks again for everybody who's tuned in today. Like I mentioned at the start, this has been recorded, so if there was anything you want to go back and watch again or have some clarity on, please feel free to do so or contact us. You know where to find us. We've mentioned the budget being on the 26th of November. We will be running another update on the 2nd of December. So depending on what happens in that budget, that will either be budget focused or not, or a combination of things. So thanks again for listening. I hope you all got something out of that, and we look forward to catching up with you again at the beginning of December. Thank you.